The efficient markets hypothesis, which is a theory that is taught in virtually every business school worldwide and widely accepted to different levels by some of the top people in the industry, is unfortunately not talked about too much in the media because there's not as much incentive in this message. But what the message says is that the definition of an efficient market is asset prices in an efficient market reflect all relevant, available, and known information, as well as the market's consensus expectations about unknown information. So what this theory is saying is that essentially everything that's known about any stock or any bond, including where we are in the economy today and how that may impact these companies, the consensus of where everybody thinks the economy is going next, all of that information instantly gets priced into stocks and the bond market. And so the first component is that makes it impossible to predict which stocks to buy or sell because that information instantly is reflected in the prices of these stocks. And then the second component, and there's only two that I'll talk about, is that if there is no predictability, then the only reason you would take more risk or buy a more volatile stock or buy a more volatile investment is if you're having higher expected return from that investment. So it's easy to show you with bonds, for example. If you buy a government bond that's paying 4%, there's no way that, let's say, even a General Motors bond is going to pay 4%. It's going to have to pay 5 or 6%. Because people know that it's at least more risky than the U.S. government. So bonds almost automatically get priced by the bond market to where the higher the yield, the more the risk is. Similar things are happening with the stock market. So the important two components to remember in this theory is one, there is no predictability because all of that is instantly baked in. And two, everything really does get priced to where it's about risk reward. The more risk you take, the more potential return you have. One example I always use is Amazon. So what this theory is saying is that nobody should be coming to you saying you should buy Amazon. It's such a great company because the market already knows that it's such a great company and it's priced it at $1 trillion market valuation to reflect what a great company it is. But on the other hand, nobody should be coming to you and saying you should sell Amazon. Its stock price is too high because again, the market has priced Amazon given everything that's known. What the efficient markets hypothesis says is that given everything that's known about Amazon, about the markets, the economy today, where that's going to go in the future and how that will reflect in Amazon's earnings, instantly gets priced into Amazon's stock price. For more information, please feel free to take a look at our website at www.aireadvisors.com. Thank you and happy investing.